again, sir, to Crypto Mondays. Always appreciate you coming out.
Thank
You're
you.
definitely one of the regulars for sure, as Pedro would say. Pedro is still in Dubai, of course, but he set this up for us, and I'm really happy to talk with you tonight.
Same here.
So we talked a little bit earlier today about some of the topics you're most interested in. We got a lot of new people coming to Crypto Mondays, so I think most of them know you, but some of them don't. So why don't you give a quick intro, like when did you come to Puerto Rico, how long you been here, how long you been doing crypto, all that, and then we'll jump right into the cool stuff.
I came to Puerto Rico 27 years ago.
Excellent.
So I was raised here and have been here pretty much forever. Started my career in finance, working for Johnson & Johnson, then did tax returns, did Puerto Rico Treasury for a bit, did big law firm, then did big BDO, where I was for manager for 5 years, and as of 3 years started my firm, Geotax. And a lot of that has to do with, crypto, and when I started getting involved in crypto, heard the term, read a little about it. So I heard the term in 2013, a little in 2014, and in 15 is where, I was telling the story.
You took the red pill at that point.
Well, no, I met Turpin and like
and that'll do it right there.
An event, and I'm like, oh yeah, Bitcoin, and he's like, no, there's more, and well, there's Ethereum. So what the fuck is Ethereum? Sorry. And then he goes, first coin agenda was in 2016, I think. We participated, and then it got fun after that.
Yeah, the whole 2017 craziness, ICOs and all that drama. My wife and I, we came here March of 2018 for that coin agenda. And it was just this amazing experience. It was like that 2 weeks was just incredible. We stayed here, came back in September, and then moved here in December.
First coin agenda, when we started talking about taxes, it was the whole conference was 150 people. Everybody left. And then outside they would like say, you don't really taxes. It's not really our thing. Okay. Right. That was in 2016. Just 1 year later or two, it was like these $5,000 people conference because everybody was caring about taxes.
Yeah, taxes is everybody's thing. The people with the guns get to make the rules. So I sometimes think of you as kind of the linchpin for the Act 2022 crypto people and their view on taxation here. And I know this is like a really big deal, and it's a little scary because every time I talk to someone, it's, well, who do you talk to? You talk to Geotax, and that's because you're that good. But also, it's like, okay, if you're wrong, we're all in trouble.
Yeah.
And so you're going to talk a little bit tonight about audits and how does that impact somebody in the Act 2022, now it's Act 60 environment, and basically, you putting yourself out there as the expert, you putting yourself out there to help so many people in the crowd here and many who aren't here at a pretty high level, I think is commendable, and it shows you know your stuff. And every time you've spoken here, I've been confirmed that you know your stuff. So what can you tell us about that risk?
So I agree with you. I agree with you so much at a level where, I'm certainly not doing this alone, right? So in Puerto Rico, yes, I've taken upon the time to understand crypto and blockchain as best as I can. I'm not a developer. Like I don't have that grace of being able to code or whatnot. But I can sit down with you and some of you who are my clients know that you can show me something, and my brain's thinking of two things at the same time. But so aside from knowing the words and kind of going back to where that application goes, and we'll speak about an example of that in the second part. Everything that conclusions, positions that I have taken do have intake from professionals maybe outside Puerto Rico, because maybe here I'm still I was the Dan of the office at one point, talking about blockchain while everybody was focused on other things, and maybe I got it right, maybe they did, whatever. But I have consulted with outside counsel when I was part of the firms or whatnot. Some of you, which I'm not going to get into, but know that we take certain positions or advise on certain positions. Well, that's been vetted by persons outside Puerto Rico in multiple occasions. So there's a team. And part of having that team is, so we wanted to talk, or I wanted to talk about audits, which is not just crypto or not just blockchain. And I have some examples I'm going to read to you about questions that auditors have made. And this relates specifically to a crypto audit, questions that may sound general or not. But all of the audits I've represented clients on, I've not done so by myself. We put together a team. Teams include people that do chain analysis, that are brilliant beyond what I can comprehend on how they can reconstruct all the mess you guys have done for years while trading.
Including DeFi? And all my liquidity pool, stake mining, and everything else?
They can do some things that are amazing, and I have two really good resources so if anybody needs that sort of advice, then through these years and connecting with these people, I've been fortunate enough to run into not only my clients who sometimes are the creators of, but then CPAs or attorneys that are the reconstructors of. So that includes, you normally have a person that can do chain analysis. You want to bring a litigator on the team. I am not a litigator. And I tell this to my clients, like, look, when we're building this team, it's like, OJ or whatever, you have everybody who's there for a reason. And sometimes the litigator is taking a backseat. And why do you want that person there? Because when you go to tax court, there are very specific timings on when you go to tax court. You can't wait till it's done. At a certain point, you get an IDR, which is an information document request. The IRS does not call that an audit. I call that an audit. The IRS is examining you and asking you questions and asking you to provide information. That's an audit.
And what's that document called again? What's it?
IDR, information document request. Information and document
That's
request.
one you want to take a note of.
Yeah. So you want a person that will be on the backseat, but suddenly say, wait, we don't provide that, or we need to understand why we're being requested this information. And you put together that sort of team, and some big firms, right? You know me, I come from a big firm and left and have a small firm. Some big firms have a tax controversy department that deals with these things specifically. But I think when you find like the right group, sometimes even if it's not just one firm, I think it works well, and it has worked well so far for the audits I have seen. So just to summarize that with your question on like, what if I'm wrong? Well, do know that there's other persons that I've found, reached out to, consulted with, that have similar or same conclusions. And, well, not to brag, but like I've been saying airdrops were taxable since I started dealing with airdrops. So, and that led, or a lot of the conclusions that I had reached on positions were based on the facts that airdrops were taxable. So when the IRS comes out and says airdrops are taxable, well, I was right, and then a lot of the positions that we've taken, are validated in that sense.
And so the important point there is you were defending your clients with foresight of what's coming, because you understood the law, you understood the regulation, you understood the precedent of what they're going to do, and your clients weren't surprised. And so you got the mic, you can brag. That's great. I think that's awesome.
No, I'm saying maybe some were or weren't, and I get pushback from clients. Like I'm not trying to be complacent with. Sometimes clients like what I say, and sometimes they don't. But do know that I am pro client, right? So I will try to find a way to understand. But if I'm saying something doesn't work, I think that's you probably because I'll try to make it work in as much as it would be possible, or find an alternative that gets you to a similar place. But
So as far as something not working, there has been a little bit of buzz in the community about audits. As far as like Act 20, Act 22 people, I think there was a post a while back that was like they've got a list and they're going to start going through this. And so the fact that you wanted to bring this to the conversation makes me think we should talk about it. So what should we know about audits for Act 2022? And for those who don't know, Act 2022, Act 60, as it's now called, is a mechanism where you as a personal individual and you can build a company to export services and have a completely different tax situation. 4% corporate tax, no capital gains. It's really, really beneficial, especially for those in the crypto space, where a lot of your gains are coming from your capital gains. You know, you get involved in a project and it becomes worth more in the future. So that's what this is. Most of you probably already know that, but it's probably helpful to say for the video or whatever.
yeah, so there has been buzz because the IRS recently issued a notice saying, they're gonna intervene with these clients or people who have moved to Puerto Rico. To me, it's not such of a surprise. It wasn't an if, but when. The reasons were, obviously, in 2004, there was the intervention with the USVI programs. And that gives us a roadmap, which is a beautiful roadmap on how the IRS is thinking or could think and what are they going to do, right? After those interventions, some of which are still going on, some of which are still in litigation, we probably got a tax court ruling on one of those maybe 2 years ago, which gives us a lot of insight. So we kind of had a roadmap of what was happening. And then, I had already seen audits. So I've already had clients. I think the first client I had audited was somewhere around late 16, 17. And
Is it as bad as the movies say?
Well, I hate it because it's a tedious process. There's a lot of billable hours involved, which is not good for you as a client. And you need to, who likes an examination? Who likes to go to the doctor, right? I've been an auditor. I don't like to do it either. I've been on the other side. I've done internal audits, Sarbanes-Oxley, all these things. And it's tedious in that way. But you learn a lot from it because my advice to clients, definitely changed from the first, what advice we gave before. And we say, yeah, we got this right before. But when I had that first audit, I started advising clients to do things additionally or differently, or you get sometimes it's the most simple thing, which I'll get to that. One of them, to me, that was I'd never advise the client to do that, was health insurance. It's not in the regs. It's not in the preambles to the regs. It's nowhere in anything that the IRS has published, 570, 937 regs, anywhere. And I got an IDR, and it says, where does the taxpayer hold health insurance? So as of that date, I told all my clients to get health insurance in Puerto Rico. It wasn't coming from anywhere, right?
And is that specific to the case where they're making a claim that this person doesn't live in Puerto Rico? Is that what it relates to or not?
Well, when they do an IDR, they're trying to learn anything and everything, right? It's broad. That's why they don't call it an audit, because it's not focused necessarily on a certain thing. And they'll hang up. There's multiple ways where you can get this. You amended your return. You won the audit lottery. You're part of a voluntary disclosure program, right? And you can expect these to happen on certain of these. But again, first time I see this is where do you hold health insurance? I'd never, again, advise a client to do something like that. Bank accounts. I'm on top of people with bank accounts. Why? Because I've seen it in audits, and they'll look through your statements. They'll look for two things. One is you don't have enough money deposited in Puerto Rico accounts. And two, I've seen in one of the ones I was going to read, and I won't read now, is we're not seeing daily activity in the Puerto Rico account. We're seeing, we want to know where the daily activity. So if you provide your Puerto Rico statements, and they say, we're not seeing daily activity there, we want to know where your daily activity is.
But having and correct me if I'm wrong, my understanding was having a Puerto Rican bank account isn't a requirement, right? It's just one of the things they look at to prove that you actually live here and do business here.
See, but there
correct?
You go, right?
I
this
know.
is where people start splitting hairs sometimes because it's inconvenient to do X or Y. But when you're hit with the IDR and the auditor's fixating on you don't have a Puerto Rico bank account, you're going to say, well, fuck, I should have dealt with Banco Popular and their $15 wire fee. Because, you know, it's going to cost you more in billable hours for me to explain why you're not paying the $15 wire fee.
Yeah.
So this is what I'm saying, why you learn from like how auditors are thinking, what they're diving into, what they will fixate in. So yeah, potentially you're right in a way, but this is like everything. One is, you know, you want to be the poster child. You want to be that audit that shuts down, like the IDR that's never an audit, that in 2 weeks they get like a no change. You know, it's like we're not going to pursue this. And I've seen that. By the way, most of the audits I've seen, which haven't been a lot because there haven't been a lot, but the ones I've seen end in no change, right? But luckily, it's been the clients that you're like, okay, you're doing this right. Another good example of something, you know, I've learned through audits was a person that you know, came into two things. This guy was past his tax court, like raising his hand and saying, I need to take this to tax court. He was past that deadline. So one very important thing, and that's why we want a litigator on the team. And two was this person was complying with the presence test by not being in the US for more than 90 days. So his defense was like, well, I haven't been in the US. I've been 1 day of this year in the US. And the IRS didn't fixate on that part. It was like, well, that's fine, but you didn't have a permanent place in Puerto Rico throughout the entire year. He was doing Airbnbs, hotels, like every time he came here. That's something that's not directly like that in the rule, right? You could say, well, I don't, you know, you could try to argue that you don't have a tax home anywhere, and that would have been the argument you could have made in tax court. In that case, it was like, well, no, this person literally fits the definition. One, it was past that point, and two, it was, you know, it's an uphill battle anyway, right? But maybe if you take it to tax court, maybe if you get an impartial, you know, judge up there, and that's why you go to tax court, right? Then you understand, or he had a better fighting chance.
So you mentioned some examples you want to read. Do you feel there are some? What do you feel we should know as not your clients that need to be protected? Is there a wave of audits coming? Is there things we should be changing? You gave some examples already. What are some other examples or things that we should know?
A wave, I think there's, yes, audits are certainly coming, and, you know, obviously once we saw GQ article, right, which didn't help the image of the program and the residents and whatnot. So it's funny, personally, I was interviewed by that Baron dude that wrote that GQ article, and I wasn't published. You know why? Because he was implying or making presumptions of things that I told him, I don't think that's true. I don't think anybody's leaving in a private jet and bribing someone to not be included in the manifest. And I told him, I'm like,
or to get a coffee receipt or something.
Yeah, or how I'm like, yeah.
I mean, first of all, why would you do that? Why would you do that when you can live in paradise?
But that's
this is the part that confuses me the most, right?
But this is what the article was. What the narrative around the article was guys in private jets or yachts leaving Puerto Rico, and I'm like, well, you know, do you know how choppy the ocean gets from here to Miami? Like, you wouldn't, even if you could afford to leave on your yacht, you probably don't want to do it. You want to be flown there, and if you're flown, those were my replies to him, and obviously I wasn't included in the article. Two clients were. I mean, when that's published, that obviously someone at the IRS says we need to look into this. We know it exists, but we need to look into this further. So the image of the programs in general, needs to be improved locally and outside of here, right? There needs to be a rhetoric to change that, because that's if you pinpoint where all the kind of negative, we're going to intervene more, because audits were always an exposure, but now like, we're going to audit pretty much everyone. If you have to say where it starts there. And there hasn't been an article of that reach with something positive coming out locally in Spanish or outside of here. So then you get, AOC and her team, and you get, the IRS is a regulator, so they're going to regulate. You wouldn't expect them to do otherwise. So anyways, if it's a waiver or not, you always need to be prepared in that sense. And I could say, I have some cases where one spouse lived in the USVI and the other spouse didn't. And that guy passed his audit because he was doing everything he needed to do. His wife and kids were in the States, but he was, in St. Thomas. So, and it's the same rule, so it would have been the same conclusion here. So there's definitely, ways to surpass this, but it's tedious. Some examples, you get an IDR, so you just know kind of what you'll be asked or looks like. It's not something too hard, but here's provide written explanation of how the taxpayer earns his living as a day trader. They want to know names of virtual currency exchanges used in the year, and they want you to identify which exchanges will provide you a statement or not, right? So and that's why we need someone doing chain analysis, right? Because what we need to tell them, look, these are my exchanges. These have some sort of software, and these don't. And that's one thing. They want to know how you track your basis and proceeds. Mm-hmm. A lot of the things here that are very important are going to be consistency. It's look, this is what I'm doing, and this is what I do every time. Because this is new. Mm-hmm. If you're consistent, you have a better case, right? Versus, well, I did this year, and then I thought it was a bad idea, and then they want to understand how you're splitting your transactions between the U.S., if any, and Puerto Rico. So that's one, just a few. And then others is when did you start trading virtual currency? And this is why do you as a taxpayer decide to transfer funds from your virtual currency into your personal account?
Oh, interesting.
What factors do you use to determine that? And then it starts telling a story. But important, the IDR is how you start telling that story is you're committing to this. And if you committed to a story where it was wrong, it was ill-advised, that's one of the points where you say, I need to go to tax court. Because tax court is de novo. If you screwed up before in an IDR or in part of the audit, you go to tax court, you start again, whole process, right? So it's a whole discovery process, etc. So that's why it's important on how you handle this. Of course, if you're okay, you're doing everything right, you're providing this information. One of the things is they'll ask for your Puerto Rico tax return. Whatever you're not reporting in your U.S. return because of a 933 exclusion should be here, right? Because you need to be compliant regardless.
That actually is the point I want to bring up. So I've been here a little over 2 years, and there are people that are mistaken when they're like, oh, that's so great, you're moved to Puerto Rico, so you don't have to keep track of all your transactions in crypto anymore. And I'm like, no, I absolutely have to. Everything is, just because I pay no capital gain, just because it might be zero, I still have to demonstrate everything that I'm doing. I don't prefer that.
You want to talk about impermanent
loss? Yes. So yield farming, DeFi, there's some crazy stuff out there. I can take a token, put it over here, a bunch of weird things happen. It's still technically mine because it's in a smart contract I control, but, right?
So, I understand why people would think that, and I know it's an easy conclusion to fall into, because if it's all Puerto Rico sourced, right, then, you still need to report the transaction and record it, but there's no tax. So, I can understand where you might think, and I'm not saying this is the right conclusion, but well, I didn't report this transaction. Hacienda audits me in Puerto Rico, and it's hey, you didn't report that transaction. It's okay, I'll report it. But since there was no tax, then there's no penalty, right? So it's hard to enforce. And that would be the case with permanent gains and losses. Someone filing tax in the US, I mean, I just couldn't understand how you could do yield farming in the US, and because everything's a taxable event.
So let's start a little bit about that. Yield farming and really compounded yield farming even gets more crazy. The idea that, and you've heard the term DeFi, decentralized finance, there are situations and there's multiple flavors of it. One flavor is I can get a loan or I can provide liquidity or value for someone else to get a loan, right? That's kind of the basic financial institutional services. But there's also the idea that you can provide liquidity, where you can say, hey, people pay millions and millions of dollars to go to a centralized exchange and move from one token to another. And they'll pay a fee every single time they do that, and they're okay with that. It's a service that's valuable to them, so they're willing to pay for that fee. DeFi comes along with yield farming and says, hey, if you're going to put up both sides, and Bancor does it a little different, and there's each one of these do it a little bit different. But basically, I take my Bitcoin, I take my USDT as a simple example, and I put $100,000 of Bitcoin or $100,000 USDT, and I put it in this smart contract, where I basically send it to a contract that is really kind of controlled by nobody, and they have automated market making. So if somebody comes in and says, I have USDT and I would like Bitcoin, they go and they put in their USDT, and the contract sends them back Bitcoin. And it changes the ratio just slightly between the relationship between Bitcoin and USDT. One of them gets a little more expensive, and it always balances out. And so if you're providing this liquidity, you are often getting a percentage. In often cases like Uniswap's like, 0.3% or something like that. You're getting a tiny percentage of the fees associated to those transactions based on the amount of the liquidity in the whole pool. So if you're like 5% liquidity, you're gonna get 5% of that little slice, right? And if you look on the blockchain, I mean, we're talking, you could scroll this fast and see how many transactions every second that are going on. And if you were to try to print that out and deliver it in a box to your audit or something like that, to say, okay, this is my percentage of these yields and these things that I have, it would be insane. And so one of the approaches I was curious about, I want to ask you about, is every time you move between currencies is a taxable event. Some people get that confused. I know there's been some recent discussion that maybe you can get away with, previously was like the real estate only thing, so it didn't apply to crypto, but now some people are saying some things differently. Basically, the safe rule that I understand is, and I'm not the tax guy, so we'll ask you after I'm done, but every time you move from one token to another, you consider that a taxable event, and it's similar in this situation. And I was wondering, can you say, well, here's what it is when I put it in the smart contract, and then here's the moment I pull it out, and that's my change in basis and whatever, this is my taxable event. The problem I would see with that is if you're in the pool through a tax season, how do you report it each month, each year? How do you report what you didn't actually, it's not in your wallet anymore, so if they do chain analysis, they don't even see it. So it's this idea of like what happens while it's there, and what responsibility do you have to report it on all those gazillions of transactions that are happening.
So,
real quick though, does that make sense? DeFi, liquidity pool provision, I see a lot of shaking heads, awesome. We have Scott Walker saying yes. If he says yes, then we got it.
So I think I'm gonna answer that question. I wanna set a foundation, right? Which is a little, I've never gotten the opportunity to be a professor, so here it goes. Every law, there's a way you read that law, and the tax code is law which you begin before you die, if you're a tax attorney. And it reads in a certain way, and you need to understand that certain things happen and happen in a way. And the first principle that you should understand in tax law is that everything is income, unless Congress says it's not. Beyond that, everything is ordinary income, unless Congress says it's not. And we talk about tax incentives in Puerto Rico. It's nothing special. The US has thousands of tax incentives written throughout the tax code again and again, and it's because they want to incentivize a certain industry. They want to incentivize a certain type of transaction or certain types of incentives. So that's why you get so much of this. But know this, anytime something isn't carved out, specified, or mentioned in a way, it's income and it's ordinary in character. And that's why I had been saying for years that airdrops would be ordinary income. It wasn't a genius, it was just unless it's carved out to be something specific, then you're not going to get an incentive. So that when we talk about DeFi, liquidity providing, we're like, what are we really doing? Well, we're lending. Are we? Well, let's see how the tax code defines lending and interest. Interest is an incentivized industry and type of income. Was Congress looking for you to provide liquidity to blockchain pools? No. They're looking for you to do bank deposits. This is not a bank. This is not a depository institution paying us interest. We don't have recourse. We're providing these platforms, these funds in exchange for a payment and getting something back in the character of it's an in-kind payment, but it's not exactly a depository account. So, we suspend that, well, is this interest? And we continue to look and we see things like, well, we don't have recourse. Well, what is this akin to? And ideas like factoring, for example, come into play, where factoring is an active financial service where we provide liquidity in exchange for future revenues. And, it's in this, like, people will call it like hard money lending or predatory rates or loan sharks, right? Very basic because of the rates at which they charge. But the tax code doesn't define what a loan shark is, but does define like, well, if you don't have recourse and it's done this way and et cetera, et cetera, et cetera, then, well, that's an active financial service. So that's more akin to ordinary income and a service.
So if you're providing a service and you're getting paid for the service, it's pretty clear that that's income, not capital gains. Is that what you're saying?
I'm saying that it's more akin to a service than other things. And we can reach conclusions based on, because these platforms will in fact treat it differently. And I reached out to BlockFi to see what's up with the 1099s, and we're currently in the middle of those discussions. It seems to me like they were moving towards a direction at one point and are now like reconsidering those positions because they don't actually want to give you recourse, right? So that's part of the whole thing from a contractual perspective as well, right? So the terms and what it is falls into that.
Well, in that example too, you're talking about a centralized system. There are plenty that are fully decentralized. There is no company that's going to issue a 1099 or anything like that. So one of the things that adds another layer of complexity to this is you do have your cost basis for this investment of sorts, where I enter a service that I'm offering and I'm getting paid for at one price point. I exit at a different price point potentially. And if I'm going to exit with a different currency than I started with, I basically did a currency exchange, and that is a taxable event. And now I've got to pay capital gains on top of, right?
Yes.
Am I thinking about this correctly?
No, you're thinking about it correctly. And that's why I'm mentioning earlier, like, impermanent losses. You're tracking
we
this.
mentioned impermanent losses. Do you want to break that down? I mean, I have an understanding of how I would describe it, but...
No, go ahead from a technical perspective.
From a technical perspective, impermanent loss is an example I gave. You put in 100 grand Bitcoin, 100 grand USDT, right? So it's 200 grand in there, right? Now, Bitcoin goes to the moon, or it crashes, either one. And these things get completely out of skew. So what generally happens is, and that's a bad example of the stablecoin. Let me use one that's two volatile currencies. So Bitcoin and Ethereum, let's say. Bitcoin and Ethereum, you're in this liquidity pool. And they're doing some crazy stuff. And one of them kind of goes down, one of them goes up. And they go in such a ratio that your total in US dollar value is no longer $200,000. You actually have less than $200,000. And you're sitting there going, how did that work? That doesn't make sense. But it's based on the way the automated market making liquidity pools work, that if the ratio is changing in such a way, they're swapping the token out, but the total value of the token is less than what you started with. It's called impermanent loss. That's about the best example I can give. I've read it a number of times myself because I really want to understand it better than that. Again, Bancor algorithm, there's some other interesting solutions to that.
It's a taxable event,
yeah.
Each and every time. So it's a taxable loss, or on the other side, or maybe on part of the transaction there's somehow a gain. It's a taxable event over taxable event. Why? Because there's nothing to codify it as something different. So we need to go to our defaults. We need to say, well, how do we treat this? And it's going to be a taxable event each and every time, and it's happening on its own. So there's the only way you control it is, well, opt out, don't do it. But if you like the returns that much, then know there's an exposure there, and being in Puerto Rico helps because at least there's still a reporting requirement, but there's a lesser penalty for omitting something involuntarily because it happened too quickly, because there's no tax on it.
So I've been told that if, like you said earlier, if you do something consistently, they'll be okay with that to a degree. And for example, there's situations where it's like there's so many transactions, you might take them together for a day and be like, this was the closing price, or you take it together for a month. And say,
I had an intervention within, and we're going back to the audits, but an examiner where he said, I can live with that.
Exactly. Yeah. It's reasonable, right?
We gave him, and well, he said, I can live with that for this. It was a multi-tiered intervention. But for that tier of the intervention, he said, I can live with that. That doesn't set precedent, right, at all. But, there was a consistent application, there was a rationale. It was explained to him by myself, by the in-house CPA, by, this is like, look, this is what we did, this is why, and this is what we consistently did all the years that are being examined.
Awesome.
So
I think we've covered most of the things that you wanted to discuss. I would love to leave it open for questions, because this is basically where you get free advice. That would otherwise be really expensive. So take advantage of it. Who's got the first question? Let's go into Q&A. And again, this is a unique opportunity. We have an expert in the house. All right, here we go.
Hi, I was curious, in terms of the closer connection test, I know you talked about health insurance is a good one most people don't think about. Is there anything else you could say in terms of recommended ways to satisfy, like, I joined X club or this group or that thing to show something? Because I'm here by myself and I'm just kind of curious, what's a good checkbox that they would love to see if they're auditing?
Publication 570 has like 8 things there. And you have all the easy ones: driver's license, voter's card, health insurance. I tell you, you have a required donation requirement, do that anyway. There are, I would say, beyond that, specific associations that you may want, because they're crypto community, whatnot, and you'll likely see me again up here soon, talking a little bit more about that, because we want to get organized. So that, and then I tell people, if you're a religious person, then find your church here. If you're into politics, then find a candidate you like. And sometimes even if you're not, write a check, because it helps for closer connections, and it helps the presence and the image, and it helps the acceptance of the guys who ultimately write these rules, right? And it's just how it works.
All right, who else got a question? Thank you for that question. Appreciate it.
Hey man, thanks for being here. So, I've been investing for a little while, and some of my funnest days are when an entrepreneur shows me an idea or a concept. I'm like, ooh, I haven't seen that before, and I don't have an opinion on it, and I don't know enough. I need to really dig into it. Like BitCloud, maybe. What are some of those issues that maybe have come up for you in the past couple of months that have just kind of boggled you, or you think like that concept is so novel?
DeFi?
Perfect.
Yeah, of course. I mean, I have to learn. I spent more time learning these things than investing in them. Hence, I'm here. If not, I'd be, some 6-star resort somewhere. But it constantly happens, and that's where it leads to the conclusions I've reached on DeFi that, again, are shared by other professionals. Started with this old tax court case Piedras Negras versus Commissioner. It was a Mexican radio station playing, its antennas had reached into the US. They operate out of Mexico, but they could sell ads into Texas, right? And the conclusion in that case, the IRS would say, no, you're providing services in the US because your commercials are heard in here. The conclusion by the tax court, which is impartial, was no, this is going to evolve. Technology is going to grow. So the conclusion the tax court reached that has lasted decades was, we're going to tax the individual who work where the button is being pushed. And that conclusion led Microsoft to, aside from technology evolving, to adapt Microsoft Office in Humacao, Puerto Rico, from printing and burning a CD to sell you a license, to a software as a service platform where Microsoft Puerto Rico owns Microsoft Office. And the guys pushing the buttons are here, right by Palmas del Mar. And that's where all your America's region of sourcing occurs. Entered ICOs in 2015, 16, and I was like, we can do an ICO from here and source the income to Puerto Rico. Because a lot of people were saying, no, ICOs are like selling equities. It's not taxable. They learned they were wrong, and I was the guy saying, you're wrong, you're not giving equity. But for the right ICO, we can do this akin to software as a service. And now DeFi. Like, there's many scenarios where we can say this is akin to software as a service. So yes, it's having to learn constantly.
Thanks for the question. Next question, over here.
I'm so sorry if you touched on this already. I was in the bathroom for a minute. But I think there are going to be a lot of people coming here who have been involved in crypto from the beginning. And from the beginning, a lot of us were in a position where we were dealing with something that we kind of thought of like a video game. It's kind of a joke. It was this thing where we were trading things back and forth. We were making decisions with assets that were kind of like silly and it wasn't going to be real. But as time has gone on and as time has progressed, there are going to be people who come here with situations where there are gaps because of exchanges that have gone under, because of records that have been lost, and their desire to establish a cost basis so that they can come clean, quote unquote, but they don't know how to go about doing that. What would your advice be to someone in that position?
There's programs in the IRS. You could submit yourself to a voluntary disclosure program, and it's pretty well organized. And once you're in a voluntary disclosure program, they're not going to go after you, right? It's you explain your situation. This is what you're doing, and and then there's a conclusion reached, which will be quote unquote in your favor and will be final. Similarly, there's offers in compromise, where you sit down, you say, you put together, this is the transaction, this is what I did, this is the tax I think I owe, and you make an offer in compromise with the IRS, and they do it the right way, they accept that, and then it's done, right? Provided those facts are current. So voluntary disclosure, offers in compromise are likely, things to adopt. That being said,
what if you're dealing with like 40,000 trades with like, sorry. What if you're dealing with like 40, 50,000 trades with like...
Well, and that's where chain analysis comes in and whatnot. But this is what I would say.
Do you have a responsibility to actually audit yourself for chain analysis to come to a conclusion that the IRS will accept?
If you're audited, you need to track your transactions and you need to provide all the information. And the difference here is you're always going to owe the tax. The difference is going to be whether you owe the penalties or not. And the difference, that's where you do one of these programs. That being said, and there's a little bit of connecting maybe both topics, like the ABA. Some of the, if you've seen my positions, some of that is, again, I'm not coming up with this alone, but I follow what the AICPA says and the ABA. I like the ABA, how they think, how they work, and what they presented in the past, which is everything from amnesty programs to suggestions on doing this. The IRS is not necessarily a bad guy. They're a regulator, and they regulate based on the code. And I understand what you're saying from a historical perspective. The ABA has requested like amnesty programs or whatnot, and that may or may not come. But the best way to guarantee those things to exist is by forcing regulation, by making changes in policy and regulation happen. But that doesn't happen on its own. Like if we leave the regulators on their own, Congress, local legislature in Puerto Rico, to kind of draft these things on their own, they're going to come up with things that maybe for you and maybe for myself don't make sense or don't connect as well. So that's why we need to, with what you know and with what I can interpret and other people in my position, we need to start pushing forward to propose what this is defined as. And this technology moves so fast that, if the IRS was catching up with interpretations, and Congress is behind them on legislation, and locally in Puerto Rico, all of a sudden we have DeFi. We had ICOs 3 years ago, 3 or 4 years. It takes 3 or 4 years to become an attorney, just academically, and it all changed, right? Or sort of changed. So there needs to be, again, from a community perspective. And when I was talking about like the tax code, forget about Puerto Rico incentives. The tax code in the US has so many incentives is because airline industry is regulated in a certain way where cargo freight, you split the tax between where you picked it up, where you drop it off, right? And the agricultural industry says, no, well, we're going to tax cattle in a certain way. So now you have more cattle, but you don't recognize the gain until you sell the cattle. And it was like, well, could we do that for airdrops? Well, yeah, let's put it in the tax code. If it's there, we can't expect the IRS to say, oh, this should be treated like cattle, right? I understand it makes sense. It's not in the code. They really don't have the authority to say airdrops should be treated like cattle. We need to present that to them. And obviously we're here in Puerto Rico, so we want to start doing that locally.
So to expand on what you're saying, the CEO of ARK Investments recently said that if you're in a position like this with Bitcoin, right, a good solution might be to wait. And it sounds like you are saying it sounds like you're saying that a good idea might be to wait. As it seems like reasonable.
That's going to vary based on individual realities.
That would be the point where you book time with geotax and you pay it, right?
Well, I think more than that, at a certain point is, no, I want to be proactive. Let's start writing this. Let's start putting this in code, even locally. And we got a little bit that far with Act 60, the Puerto Rico Incentive Code, when, and I say this over and over again, there wasn't a big enough fuss made about that Puerto Rico has legislation that includes both the term blockchain and cryptocurrency in a law. Just be it, by defining what blockchain is or blockchain as a service is, which actually it predicted the future, because now that we have all this DeFi stuff going on, we can say, oh, in 2019 you approved this wording that helps us this way. We just need to push it that much far. So from an individual perspective, yes, maybe people want to wait, but as a community, no, I think we wanna be able to say, hey, Puerto Rico law such and such says this is how I should treat this. So I have authority. So I have substantial authority by a legislative body, by a regulatory government that says this. So.
All right, so we got time, I think, for maybe one or two more questions. We got one right here, and then we'll get one over there. I know you guys want to hang out, buy more food and drinks, so go ahead.
Thank you, Giovanni. Good stuff. So my question is, you mentioned something about voluntary back here. Voluntary disclosure. So are you recommending, generally speaking, that if the prevailing wisdom is that audits are coming, everyone's getting audited, just engage with the IRS right now?
That's very individual, right? Because these programs have rules and requirements and whatnot. So we'd have to see. We'd have to see what, and that's an individual determination with the exposure and its benefits.
Okay, quick follow-up question independent of that. Sorry if everybody knows this in the audience, but you mentioned BlockFi. What's the simple interest earning in a stable coin through BlockFi or any of those centralized platforms? How is that treated? Is it income? Is it interest? And where is it sourced from?
There isn't a simple way to put that because it's going to depend on what's actually happening in the background. If you are in fact lending or making deposits and earning depository interest, then it's that. But if it's more akin to a software as a service, which it is in some cases, or I mentioned the example of factoring with providing liquidity, then that's an active financial service. So it's more in the lines of ordinary income. But that could vary by platform or methodology or what's really going on. Is it really a deposit? Is it really a loan?
Over here.
Yeah, so as a strategy, I'm wondering if you're going to sell kind of like everything that you have to lock in whatever that capital gains is, if that would be wise, because then if there's ever an audit, sometime maybe they don't audit you at that time, and then several years later they do audit you, but it's they're sort of they're not necessarily going to reach back as far because that has already been concluded, or whether or not by sort of selling everything, you're creating a very large abundance, and that's like a trigger. Is there a trigger for size?
I couldn't say, but if you're following the set of rules and there's no material misstatement, no fraud, your statute of limitations is done and not extended beyond that. So I wouldn't implement a strategy to accelerate the statute of limitations. I just let it run its course, and you do your investment based on what you think is the right time, based on whatever your criteria. And it's more about just complying with being here, accounting for this the right way, etc. But I never. I wouldn't advise anybody to, accelerate and sell, get out of your portfolio, and because even paying the tax, you're like, well, I would have waited to $150,000 Bitcoin and paid the tax, then sell now to avoid paying tax or something like that. It's like.
You just get back in, there's no washing, so you sell it.
So that's an interesting question. I've heard that before. Some people, when they move to Puerto Rico, they sell.
I've at one point I believed in that. I said, well, maybe it's a clean slate. I think there's still substantial costs to a transaction like that. So I don't think it's as easy. If you have a way to do it and no cost to you, no volatility, no fees, then maybe I'll just do it this way and have a fresh start and whatever. I'm not aware that there's an entirely risk-free, no-cost way to do it. So I think the cost is still substantial enough where you have to wait.
All right, so last chance for any other questions. We've got a little bit long, so we got one more over here.
What's Gio's favorite drink? No? Nobody's asking that?
Which Act 22 or Act 60 person pays the most taxes in Puerto Rico?
Are you asking him to expose his clients? I don't understand the question.
I don't know. It's an interesting question from the perspective of people think that the Act 2022 community doesn't pay tax. So going back to improving the image, part of improving that image is yes, being more public on the amount of tax paid by. Before Act 2022, there was 1,000 persons in Puerto Rico. So before 2012, 1,000 persons in Puerto Rico that reported salaries of over $100,000. That number I don't think was accurate, but that was how it was reported, and that's definitely increased significantly since. So having clarity on those figures is very important to say this program is working. You know, I've done in a single transaction, you know, sold, one was 5, another was $8 million in tax credits. So that was the liability that individual taxpayer had in tax. They're paying $8 million in tax. And there's a lot like that. There needs to be a lot more visibility on that because it helps the program on how it's contributing, saying, well, you know, you're getting 4% of this, or well, that person didn't exactly have an entirely tax-free transaction. You know, it's tax-free at this level, but even this minimum level that was taxable is way more than the 1,000 persons reporting 6-figure salaries in Puerto Rico. So
Awesome. You will love it. It's an incredible place to be. Thank you again, Giovanni. Thank you all for showing up. Another round of applause, please. And thank you for our amazing host. Please, again, tip well, order food, order drinks. Thank you all again. Good night.